Hi, everyone. This is Jason Barrett of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today, John Manfreda and I are joined by a special first-time guest, but I've been following his work for years. He's one of my favorite oil and energy experts. He's Dr. Kent Moores. He's a PhD. Dr. Moores is executive chair of the Global Energy Symposium, a major initiative involving some of the world's leading energy experts. It oversees high-profile analysis and policy recommendation to governments and agencies worldwide. He has left his university position, professor in the Department of Political Science and Graduate Center for Social and Public Policy at Duquesne University, where he was also scholar in residence at the Institute for Energy and the Environment to head up this global effort. He's been in the oil industry for many, many years, and he also writes a successful newsletter for the Oil and Energy Investor, which is published, I think, by Agora Financial. Thank you for joining us, Dr. Kent Moores.
Well, thank you.
Okay. The first question I wanted to get into was the oil market. Ever since June, the market's really taken a dive from $97 to the current price. I believe it's like $50. Why do you think it dropped so far so fast, or so low so fast?
There are a couple of reasons for that. One is we've had a lingering oversupply for some time, which has intensified. Traders have been eyeing it. We were essentially balancing a known oversupply and an additional ability to add to the markets beyond that on the one hand, with geopolitical uncertainty on the other. And finally, it was the supply side that trumped. Now, much of what has occurred in the latter portion of December, we've had essentially a push back up a bit here in January and early February. But most of what occurred toward the end of last year was an overreaction by traders. And one of the things we're going to see in the market over the next 2 quarters is a balancing of expectations and reality. We will see a decline in production in the United States. We will see a cut in capital expenditures moving forward, but these things take time to work out. So we're in a situation right now where the waves of volatility in the oil sector are high, and they're probably going to remain there for some time.
Yeah, Dr. Moores, it seems that a lot of the OPEC countries, basically everyone except for Saudi Arabia, really can't make much of any money at these prices. Now, maybe, a smart, prudent firm, whether they had debt or not, a United States oil producer, maybe they hedged their oil production at a much higher price. But, a lot of these oil production firms, no one saw the prices declining and having this much of a rapid correction. A lot of the other, your analysis and a lot of other oil energy experts I saw maybe thought the oil price would drop a little bit. I know I follow Robert Rapier's work, and he thought the oil price would drop in 2014, but he didn't expect it to drop nearly as much.
Absolutely. I mean, if someone tells you today that they thought it was going to drop 60% in a period of less than 5 months, then they're blowing some smoke. All of us saw that there was a retrenchment coming. No one could foresee that it was going to be this high. We're in a curious situation now because it used to be that every month we would eye the call on OPEC as being the balancer for the global market. And the call on OPEC has now essentially been replaced by a call on Shale. U.S. shale producers are now the balancing agent for determining price internationally. So the Saudis got what they wanted, and that was maintaining market share. But they essentially have got it at the expense of losing control over who balances the market.
Yeah, that's a great point, especially since I also see Canada right now. They've actually cut CapEx too. Do you think there's any way that Canadian oil sands could play a role as a swing producer at all with shale?
Well, we have to remember that you have to now make a major distinction between projects that are already up and operating and those that need front-end investment. About 80% of all the investment in a project takes place before you get anything out of the ground. So if you've already got a project operating at this point, it behooves the producing company to keep it going. We've got a dynamic, however, that's taking place here where by 2025 or maybe even earlier than that, North America essentially is self-sufficient in oil. And where the United States was importing almost 70% of its oil as early as 5 years ago, 70% of what it needed daily. By 2025, we're going to be down to about 30%, and virtually all of that can come from Canada. So the only imports we're going to get from other parts of the world are imports that make sense given pricing differentials, an ability to hedge contracts for longer periods of time. And in this particular situation, the exchange between Canada and the United States is decisive. The ability to move oil sands production south of the border is entirely dependent, of course, on the production costs in Canada, but it's also dependent upon where your uplifters are, what the ability is of the refineries in the United States to produce heavier crude. And we've already seen some very heavy investments over the last 8 to 10 years, even in the American Midwest, which is now allowing major refineries to treat the heavier oil coming down from Canada without the Canadians having to upgrade it first. And I think that's what we're going to see progressively, more raw material coming south to be refined in the United States. So that's a long agreement. That's a long answer, agreeing to the fact that the Canadians do hold a balance here in terms of what is necessary in the American market. And I think you got to remember something else about OPEC in general and the Saudis in particular. They want to entice a cut in production in North America and also in Russia first, but they don't know what the triggering prices are. So this is very much an exploratory operation by the Saudis to find out what price is necessary to maintain a balance internationally that allows them to retain their market share. Because remember something, 86% of all the recoverable unconventional crude worldwide is not located in North America, which means that this battle the Saudis currently have with the United States and Canada, we're going to play out again and again as shale and tight oil begins to be a developing opportunity elsewhere in the world. This is going to go on.
Yeah, it seems you mentioned the point there about potential economic warfare maybe between the Saudis and Russia. I've heard from other sources, whether it's Zero Hedge or I think even President Obama let it slip on a recent interview in the last month or 6 weeks, that, as part of their sanctions against Russia, he wanted to go to the Saudis and OPEC and try to knock the oil price down at least temporarily to, stick it to Putin because the U.S. doesn't like foreign policy. How much do you think then is geopolitics playing a factor in these low oil prices over, supply-demand fundamentals?
Well, I think there's always a geopolitical factor, and here with the rising acrimony between the West and Russia, that geopolitical factor is intensifying. The battle here is Asia, where all of the global demand is really going to be concentrating through 2035. And here the Saudis specifically, and OPEC in general, have a rising competitor from the Russians. Russia has finished the ESPO pipeline from East Siberia to the Pacific Ocean. It's providing a better quality of crude than what's available in general Saudi export crude, and they're beginning to provide it to Asia at a discount price. The Asian premium that everybody was used to, and that is that an Asian end user would need to pay more for the same amount of crude being delivered than an end user in either the United States or Europe, was beginning to abate because of this new Russian flow. So a real competition, immediate competition in terms of market share existed between the Saudis and the Russians. So what the Saudis did was they first cut their prices to Asia. Then they had OPEC maintain production to put immense pressure on the Russians, whose central budget really this year needed a crude oil export price of between $80 and $85 a barrel, which they're not going to be getting. And we're already seeing a cut in the Russian exports into Asia, and we're beginning to see, because of that and the Western sanctions, some pressure being placed on maintaining production in traditional Western Siberian fields. So what it is the Saudis wanted to do with the Russians, by and large, was achieve short term. The cuts by non-OPEC producers has begun first with Russia, but the primary opponent here remains American shale producers. And we're beginning to see that. We will see more of this as we move in further into the second quarter of 2015. But we see this knee-jerk reaction. If there is a surplus in stockpiles emerging from the American Petroleum Institute and the EIA surveys each week, the price of oil will go down. And then on Friday, you get the Baker Hughes rig counts. And as the rig counts continue to go down in North America, then the price of oil starts going back up. Traders are looking at very immediate indicators here to try to determine what the overall production level is in North America. And really so are the Saudis, because there's really no track record on playing this kind of geopolitical game. Their ability to maintain market share, I think, is very much a debatable issue. And as I've mentioned several times, both in print and on the air recently, controlling 40% of the world's global crude oil just doesn't buy what it used to. OPEC just doesn't have the leverage it used to because there are more alternative sources, and that the Saudis can't control.
Yeah, I definitely see that. And to keep this Saudi market from falling due to low oil prices, they introduced the largest deficit for the year 2015 with estimates because they're increasing their social programs. And and I was wondering, what do you think happens first? Right now, shale oil, their production cost, from what I read, is $65 per barrel, not including the debt. You know, a lot of them have a lot of debt on their balance sheet and finance that drilling through debt. So if you ask me, the costs are higher. Or, you know, civil unrest in Saudi Arabia, or another Arab revolution, which the Saudis bribed in 2011. What do you think would give first, and what would happen if these prices sustain? Could both of those happen?
Well, the two really separate issues. First of all, let's talk about the overall profitability limit for shale production. You've got to remember that many of the medium and larger sized shale producers, and the ones that I look at particularly, are those companies that have ongoing, well-structured, efficient operations in high-producing basins with full infrastructure already developed. So I'm not looking at the entire market. I'm looking at particular, probably 100 or so producers in the United States and taking my keys from them. Virtually all of these are hedging at least 70% of their production into next year. So when people say it's $65 or $62 or $60 a barrel is the break-even point, that's the break-even point without hedging onward production. You actually can continue to operate well below that level for a period of time. That's number one. Number two, going to the Arab Spring, and we're already moving into Arab Spring 2. And Arab Spring 2 is going to be far less settling than Arab Spring 1 was. The reason for this is a number of the producers actually bought off their populations by using oil proceeds to increase social programs. And it is necessary because of a very high unemployment rate, of the fact that most of these economies are not diversified, which means most of what they need they really have to import from someplace else and pay hard currency for it. That is also the Saudi problem. The Saudis, United Arab Emirates, and Kuwait have an advantage of very large hard currency reserves. The Saudis can run a huge budget deficit well into the future without having any impact whatsoever in terms of their social structure. The big concern we had recently was the death of King Abdullah and the accession to the throne of King Salman, and the question of whether or not the last descendants of the initial king, once that line is finished, whether we have increased social instability when we're moving from one generation to the next in the Saudi royal family. And I think that's probably an issue we're going to have to consider seriously, but not for another 5 or 7 years. And I think the royal family is already making some very concerted plans to bring in the next generation. So I don't see a Saudi unrest as being likely. I do see unrest in other parts of the Middle East increasing quickly. And the place I keep telling people to look at is not the place that most people think of. You should take your leverage right now from Bahrain. Bahrain is not a major oil producer. It's a very small country, but it has the one thing that everybody fears. As the unrest intensifies in Bahrain, this is a Sunni minority royal family against a Shiite majority population. And that's the one element you want to keep out of the Arab Spring unrest, but Bahrain's going to guarantee it comes in. So we're going to see an unrest here that's intensifying. And outside of Saudi Arabia and a few other countries, these nations no longer can afford to buy off their populations. So this is likely to get nasty.
Yeah, I agree, especially a country like Venezuela, which because of socialism and Marxism that they run down there, they don't reinvest really any of their oil profits back into the business, into new technology, improving their refineries, finding new oil reserves or lowering production costs or anything like that. So, I think Venezuela, they're basically defaulting on their bonds now, or they're very close to doing it. And then, in Russia, Putin's approval rating, I think, I just read a story, it hit 85%, and I think the way, I don't know how much truth there is to all these different things, but he's spinning it that, all of the oil price drop is all due to, manipulation from Wall Street, the Saudis helping the U.S. government and Wall Street manipulate the market lower, but the Russian people are buying it. So even though there is more inflation and Russia's not making as much money as it did on oil and natural gas, before June, it just seems that the Russian people are, not as upset with it as maybe citizens in other oil countries where they're feeling more of the pain right now.
Yeah, two things to remember about the Russian situation. One is they're already technically in recession, but I think the bottom is pretty much hit there. If you take a look at the ruble exchange rate is well below where it was before they were hit with the oil price declines. But it is getting steady. That's number one. Number two, people shouldn't read too much into some conspiracy of the West to try to remove Putin. Because as you look, if Putin were removed, I'm not certain that the West would like any of the people who would replace him. We're back to the situation that we saw generations ago where we may not like a foreign leader, but we like the stability more that foreign leader creates than the power vacuum that would take place if he were removed. So we have to be very careful diplomatically to try to walk that bridge between disliking current policy and letting Putin know about it, but on the other hand, recognizing that having the guy in office may be the lesser of several evils. And
sorry to interrupt you. And about Venezuela, what do you think the probability is then that their oil production could drastically decline or come offline in the near future? As they're having enormous currency problems there. There's just shortages with toilet paper and rice and electricity and things and beans and things like that. Do you think it's a high probability event then that their oil production could potentially come off, most or all of it could come offline in the near future, and then maybe the U.S. government or the Chinese government goes in there and tries to put in a new regime?
Well, it's you're actually dealing with two questions here. Venezuela is where I was going to go next. The Venezuelan situation is dire and getting worse. Venezuela is one of the three OPEC nations, Nigeria and Iran being the other two, that need an average price, international price of crude well above $110 a barrel to have any chance whatsoever of balancing an atrocious budget, and they're not going to get it. So the economic situation is worsening. Several years ago, it was so bad that PDVSA, the national oil company, was required to spend portions of their profits, much of which comes from Citgo, the Citgo network in the United States, but to spend a portion of their profits importing food into Venezuela. The national oil company was required to import things that they know nothing about because the structure had already collapsed in the country. The banks have collapsed. You're quite right in saying that they're nearing and in some cases effectively have already defaulted on their sovereign debt. And this is getting worse. We're getting riots in the streets. We're getting an unraveling of the social fabric, and this is going to be very difficult. Now, they've got a tremendous amount of oil reserves. They have one of the largest oil reserves in the world, but this is Orinoco Basin heavy oil. And when the government kicked out the main Western oil companies several years ago, their idea was they were going to bring in the Russians, they were going to bring in the Chinese. They even set up a multinational Russian, Chinese, Iranian, Venezuelan bank to subsidize this. The problem is the technology really isn't available to develop this heavy oil anywhere other than really in the United States. This is why when Exxon and Rosneft, the state-run oil company in Russia, set up their joint venture, one of the primary things Rosneft wanted to get out of this was a minority position in several dozen Western Exxon projects. Every single one of those are heavy oil projects. They need access to the technology, primarily because they need the heavy oil technology to resurrect domestic production in Russia as well as elsewhere. But we've got a situation here where the people who were brought in to replace the Western companies simply can't do what is necessary. So yes, you're going to get a production shortfall here merely because the technology base isn't sufficient. Now, it's a big jump from that to say, okay, maybe the Chinese and the United States may want to change regimes. The regime isn't the issue here. The economic situation has collapsed. So it doesn't really make any difference who it is that's overseeing a collapsed economy. It's still a collapsed economy. And the Chinese are more interested right now in getting a return on the immense amount of money they've loaned to Venezuela than they are in any political changes. It's interesting. Beijing has now become more accountable and predictable in terms of international fiduciary standards than they ever were before. They're now a genuine player, and they need a return on their investments.
Okay. I was wondering, I actually just wanted to switch topics real quickly about the drillers. One thing I heard about from listening with the conference calls from Halliburton, Precision Drilling, and other ones is that right now there's a serious talks about lowering prices for the oil producers right now because it's a very struggling time. How much effect do you think, or how much lower will the prices be? Will the drillers have to lower it for producers, in your opinion?
Well, it depends on the basin, number one, and it depends on the range of services. Halliburton and Schlumberger, Schlumberger has entered into this huge deal with Eurasian drilling in Russia, and Halliburton, of course, is merging with Baker Hughes. So we're seeing these further consolidations, and these have been going on for years, where the big boys want to become a one-stop shopping outlet. Everything you need for field development, from initial geological seismic surveys down through well completions, you're going to get from the same provider. Halliburton and Schlumberger's idea on this was, as they consolidated more of this under their own control, they could pretty well standardize prices and give a range of services, but have fewer competitions. It was even to the point where Halliburton especially, but also Schlumberger, were acquiring companies that produced drilling equipment. We were beginning to see this this horizontal consolidation taking place in oil field services. Well, that's been derailed somewhat because of the drastic collapse in oil prices. So we're beginning to see drilling companies provide certain discounts in return for guaranteed longer-term contracts. Now, Halliburton and Schlumberger had already pioneered this. If you were an operating company and you had several projects that you needed drilling at, because one of the biggest problems we were recognizing was the time lapse between finishing the borehole and completing the well was extending. And it was up to almost 28 days in certain places in North America before the price collapsed. And what that simply means is there was insufficient oil field service equipment available, and it was causing operators to lose profits. So the big boys were saying, okay, we will give you a designated team that will follow your operations from one field to another. In return, you have to sign a contract. The contract requires you pay a premium. But the advantage was the company had their services, and the Halliburtons and Schlumbergers of the world knew where their teams were going for a longer period of time. That only worked when the market was commanding a higher price. That now doesn't work. And so as a result, Halliburton and Schlumberger have a rising number of teams, that field teams that no longer have anything to do. We're seeing unemployment. We're seeing mothballing of equipment. We're even seeing a slowing in the M&A cycles where they're acquiring other companies. And in this scenario, it is really the buyer's market that's coming in. A good, efficient, well-run company operating in a basin they know well with an infrastructure that's completed can now actually produce at a much lower price because the OFS providers are going to have to give them a discount. And, that's an interesting twist. It's not going to last more than 2 quarters, but at least it's an interesting scenario right now.
Yeah, I wanted to follow up about you spoke about Halliburton. They have a famous ongoing merger with Baker Hughes. And right now, antitrust regulators have expressed concerns about adequately replacing the lost competition if Halliburton and Baker Hughes merge. Do you think antitrust legislation is going to block this merger?
I think it's unlikely. 2 things you have to remember. Number one, if they weren't going to block the American Airlines U.S. Airways merger, they're going to have difficulty blocking anything. That's number one. But number 2, the way you get around this is you wait, find out what are the specific concerns of the regulators, and then you spin off those portions of your overall corporate structure. You give up enough so that the regulators will approve it. And we already see the model that's going to take place here. If you take a look, this had nothing to do with regulators, but if you take a look at what the major refineries have been doing, the major refineries have been spinning off midstream assets they used to own into separate companies, either master limited partnerships or other kinds of limited partnerships that are now running separately. The advantage is this new pipeline company has guaranteed contracts from what used to be their parent operation, plus they can also go out and look for other end users who might need their services. We're going to see the same sort of thing here. We've seen it in other parts of the world. This is the way, for example, that these huge holdings were assembled in the former Soviet Union, where technically you have 80 separate companies, but if you take a look at what's actually happening, these companies have guaranteed contracts with each other, and even though they may be independent, they're operating just about as one unit. This is how Eurasia drilling, for example, was created. We're going to see the same thing here, so that Halliburton may spin off enough companies so it looks like competition. But in point of fact, those companies are still going to be dependent upon Halliburton contracts, so in point of fact, Halliburton still controls the Shale.
Yeah, that's interesting. I think a lot of these MLPs, especially in the midstream space, if they have their cash flows locked in, I think they're pretty good, at least yield investments. I wouldn't expect any capital gains out of them necessarily, but I think their yields are fairly stable because I think we're just consuming so much oil each day and each year that, even though the oil price dropped, eventually there's going to be more oil and more gasoline consumed at these low prices because in the long-term markets work in that way. The cure for low prices is low prices.
Yeah. And the other thing to remember about several MLPs, the disadvantage of an MLP, and Kinder Morgan was a good example. If you reach a certain size, you can maintain your dividends only by acquiring companies at prices those companies don't deserve. So at a certain point, it doesn't make sense to get too big as an MLP. But an MLP runs profits. If an operating company has to move its volume from point A to point B, or it has to store its volume between point A and point B. If you take a look at the natural gas side of it, we've got huge stretches of natural gas pipelines in the United States where the primary capital expenditure right now is to put loops in existing pipelines. It has nothing to do with transport. It has everything to do with storage. We've got pipeline networks in the United States in which an absolute majority of that pipeline volume is used for storage, not for transport. And we're beginning to see the same thing in certain designated regions for crude oil, especially when the prices start going down. What we're seeing is that new MLPs, I call them MLP clones, there's these new structures that are being set up in which pivotal assets in various segments of the midstream process are being cherry-picked and put into new holdings. These are the areas where profit can be maximized almost regardless of what the overall market looks like. The only caveat here is if you have an absolute collapse in market demand, then the MLPs go under. But short of demand collapsing, having an increase or a glut on the supply side is less important here. You can still maintain profit. So we're going to see limited partnerships, especially in midstreams, becoming more and more acutely aware of what are the better asset acquisitions rather than simply acquisitions in bulk.
Yeah, the MLP IPO market has just been really popular. Like you said, I think Royal Dutch Shell and some of these other larger companies, which, had missed it, had not really done anything or participated in it. We've seen refiners spin off assets or pipelines they own connecting to their refineries into MLPs. So I think that's been a hot market trend. I actually covered MLPs a couple years ago when I was working at a larger firm. I think it's a good source. I'd much rather, Ken, I don't know about you, but I'd much rather own an MLP midstream business that generates cash flow that way, and maybe they can, have pricing power or grow their business and grow revenues and maybe run their business efficiently than owning, sovereign market bonds or certain types of corporate bonds. I think MLPs are a really good yield substitute, an income substitute instead of, bonds, especially from a lot of these countries, because I just don't like the finances of many of these countries right now.
Right. We're a few years away from having an interesting new development as well. We're going to have some MLP clone holdings that cross borders. And when that happens, we're going to see a whole new, this is a double-edged sword, we're going to see a whole new generation of middle paper being created to be able to equate the assets to the debt that's being generated. There's a lot of interest on this now in the city in London, where people are priming for this.
That's very interesting, but the market, because there's so many investors out there who want yield, that seems the market will be receptive to new types of income and yield investments.
Yeah, I mean, if you can end up using an asset class as a way of strengthening one's debt, you've got an interesting place there to introduce some new paper.
Yeah.
Now, my next question, Dr. Moores, has to do with deep water. At these prices, the majority of the world's deep water offshore oil doesn't seem economic at all unless they hedge their oil production. Petrobras, their financials just seem really bad right now. They haven't gotten their production to any of the levels. There's been capex overruns. We've seen, the deep water offshore players like Transocean and Seadrill, get pretty hammered and start to shut down rigs and things like that and lower their prices also just to get any business. It seems to me that for the long term in the oil market, for any type of supply growth, outside of the U.S. shale oil production, the majority of the world's oil production growth is going to come from deep water, either offshore in Brazil or South America, or in Asia, or in Africa, Western or Eastern Africa. Do you think deep water can survive low oil prices for another 6 months or 12 months, or are we going to see a lot of bankruptcies here in the deep water space?
Well, I think it's premature to talk about bankruptcies there, but you're quite correct. There was an international report that came out a couple of years ago that estimated in traditional crude, just forgetting about shale and pipe, just traditional crude, upwards to 70% of the available elephants, very large fields, yet undiscovered, are deep water. I mean, the preponderance of opinion was that in traditional oil, the primary huge fields yet to be discovered are deep water. So it's been known for some time. The other thing to remember is that it is far more expensive from the standpoint of capital expenditures to actually develop a deep water field. On the other hand, once you develop it, you get a much higher spike much more quickly. In other words, your production curve accelerates far more quickly offshore than it does onshore. What that means is you're going to get a return on your investment quicker. So if you talk to petroleum economists these days, you know, they're not simply talking about, you know, what's the cutoff on what's profitable and what isn't. They're talking about what is the spread in terms of the profitability. And there it depends not merely on what you get at the market versus what it is it costs you to bring it up. It's also what's the volume, what's the range, you know, what is the reservoir penetration. There's a number of other things that are going on here. There's always going to be a place for offshore. And the big advantage is if you take a look at the Gulf of Mexico, and the Gulf of Mexico has several zones, and you're really out there before you get to deep water. If you take a look at what's occurring in the shallower confines of the Gulf, the pricing range there is still palatable, given where oil is today. So we're not seeing a great cut in close and shallow production. We're not even seeing a cut yet in deep water production. We are seeing a rethinking of launching new multi-year projects, but that's essentially where your cuts are going to come first. So there's still a place there, and you got to remember that the essential price of crude is determined in places other than North America and Western Europe. And I keep going back to Asia. The offshore deep water options in Asia are far more palatable because the price that can be commanded in the Asian market is far higher. And we're already seeing some of the companies. I mean, Diamond Offshore, for example, moved from the Gulf to off of Egypt when the United States was making additional leases less likely several years ago. We're now seeing companies like Diamond Offshore moving to Asia. And we're going to see more of that in the future because that's essentially where domestic production in Asia is going to be an even hotter commodity than importing energy into what is really the next huge demand cycle.
Speaking of offshore or deep water drilling, BP is heavily invested in it. And right now there's a rumor of Exxon buying out BP. My question is sort of two-part. What's BP's viability during this downtrend? And do you expect Exxon to buy out BP?
My answer is, the first one is, I don't see any real wall coming up for BP in the foreseeable future. Although I'll be with their chief economist in a couple of weeks, so I might get a better view at that point. The other thing is Exxon would have to, I was about to say they'd have to be insane. It is not in Exxon's interest to become that large. And there really is too much of a downside in terms, forget about the suits, forget about the Gulf of Mexico disaster. BP has too many projects spread in too many places. If you acquire it, you acquire a lot of inefficiency. This is a company that literally takes scripture literally. Its left hand doesn't know what its right hand is doing. It's got cost overages. It's got duplications where it doesn't need it, and it's got projects that just a lot of sunk costs. The projects just aren't performing as well as they should. There's a lot of excess baggage just below the surface in BP, and if I were advising Exxon, I'd say you're big enough already. There's no point in acquiring a company that's going to create as many problems, I think, as profit potential.
Yeah, I heard Royal Dutch Shell was also looking into it, but I have a feeling since China has, so much surplus treasuries in dollars that maybe China will finance, like Chinese banks or the Chinese government will finance, the ability then for one of the large Chinese state-run oil companies to go in there and maybe not necessarily buy up all of BP, but start buying up maybe 50% joint venture interest in some of their projects or something like that, because I think the Chinese are more long-term forward thinkers, and they just want to get out of a lot of their dollar holdings, and they view oil as undervalued, and they'll try to lock up more oil production at these prices over the long term.
Yeah, it's interesting because right now the Chinese are more interested. They're still acquiring operators, operating companies. But if you notice what they've done, several years ago they were gobbling up every Kazakh and Canadian company they could get their hands on. The idea being that additional production would be moved back to mainland China. And while they're still interested in that, the new phase in what China is doing is they've learned that Chinese money can control the export flow from given countries. Ecuador is the smallest OPEC producer. China now controls Ecuador's oil exports. And they control Ecuador's oil exports because they've given so many loans to the central government and to Petroecuador, the state company, that the government can only pay back those loans by paying it back with oil export proceeds. So the Chinese have become far more sophisticated. A good deal of that oil still goes north from Ecuador. China's less concerned right now about getting that oil back to China as it is in getting the oil proceeds back to China. That will allow them to be a bit more selective. They may well be able to nibble at the edges of a BP. But remember when BP was giving up its assets, was selling its assets in anticipation that it had to set up a war chest moving into these litigations in Houston. The Chinese weren't that interested in them because BP had some assets the Chinese would be interested in, but those were offshore Vietnamese assets, and those were quickly gobbled up by the Russians because it's a Russian-Vietnamese joint venture that's essentially been operating there for years. And once that took place, there just wasn't anything else on the selling list that the Chinese were that interested in. They're getting more sophisticated, and they're getting more selective on what it is they acquire. What they need is technology. And so we're going to see more Chinese moves into global projects that will introduce them to the technology they need. Remember, they've got more extractable shale gas and shale oil than anyone else in the world. And so the next phase there is the Chinese would love to start developing their own domestic sources. But for that, they need a technical base they simply don't have.
Yeah, and that's a good point about China. And also, if I could add to one point before John gives a follow-up question to you about China, is that the Canadian government they changed the rules after China made some investments in Canada, I think, for oil, that China can only do now, I think, 50% joint venture deals with Canadian resource companies, and they can't buy 100% of a Canadian company anymore. So maybe we're going to see that with not just Canada, but other countries going forward where the Chinese are not going to be allowed to buy 100% of companies anymore going forward.
Right. I mean, Kazakhstan had to put their foot down even earlier. This was a couple of years ago, where the Majlis, the legislature in Kazakhstan, I mean, one day they realized they really didn't know how much China owned in the hydrocarbon sector in Kazakhstan. So what they've done is they've set up very strict limitations on what the Chinese can own, what the holding companies look like. And the Kazakhs were first doing this, and they were the best at it. They now won't let you come in. Any foreign company cannot come in unless they can guarantee certain percentages of highly skilled jobs will be held by Kazakhs after 3 years, 5 years, 10 years. And companies would say, well, you don't have any specialists. There's no Kazakhs we can hire. And the Kazakh government would smile and say, train them. So now you have Chinese companies that have to import Western specialists to train Kazakh individuals working at their fields in Kazakhstan before the Chinese are allowed to purchase anything more. So there are limitations, very detailed limitations, that are being set up to prevent the Chinese from simply going in and regarding it as a fire sale.
Yeah, speaking of China, I've actually read something on Reuters and Bloomberg that they're actually considering a merging of all three of their national companies. Do you see that happening in the future, or not yet, but it's only a matter of time? What do you see? What do you think about that possibility?
Well, there's an advantage and a disadvantage. This isn't the first time they've kicked this around, by the way. What you will see and what you're already seeing, and you can see this in terms of, take a look at where the principal top executives at PetroChina moved to. You're essentially having that consolidation on the ministerial level, which is really where it ought to be. Because the other side of that coin is you do need to have specialized providers. Just having a big holding isn't good enough, and it doesn't automatically mean you're going to increase your efficiency merely because your upstream, midstream, and downstream activities are under the same corporate rubric. Take a look at Sinopec, for example. Sinopec now essentially operates under two companies. One is becoming more primarily a domestic petrochemical provider, and the other is the company that's actually going out and acquiring holdings in foreign operations. And even though they're under the same overall structure, you really have very separate functions that are taking place there. And the Chinese realize this. There is an advantage in keeping those functions separate. Once you combine them, you're going to decrease efficiency and you're going to increase capital outflow, which is not really. Now, they got plenty of hard currency reserves, but there's no point in wasting them. So I think we're going to see on the policy side, on the ministerial management side, you're going to see a consolidation. But in terms of the actual companies, those companies are going to remain separate. And remember, by remaining separate, they each have their own, equity generation capability, both in Shanghai and in Hong Kong, and in Singapore, for that matter.
I have two more questions, Dr. Moores, before I'll let you go. I really enjoyed this conversation, though, and hopefully we can do this again sometime in the near future. But my last two questions, and I'll ask the first one now, is how much longer, in your opinion, do you think oil prices are sustainable at these levels, before we start seeing a lot of supply shut off or bankruptcies or things like that?
Well, that remains to be seen. If we are still at a $50 to mid-$50 per barrel level 6 months from now, we're going to see a rapid increase in mergers and acquisitions, and we're going to see some bankruptcies. Now, I'll give you an indication. This is already happening, and it's one of the things that in my investment services, we just moved in and out of 3 very small companies in a matter of 4 days, where they spiked in anticipation they were going to be acquired, and they sank when they weren't. But take a look at Lucas Energy, for example. Lucas Energy has some of the best prospects in the Eagle Ford, the Austin Chalk, and the Buddha Formation of just about any company, but they don't have the money to be able to develop them. So they ended up in a financial merger with a private company for the purpose of being able to generate enough capital expenditure to be able to develop these fields. Lucas went up almost 100% in about 3 days. We're going to see both straight acquisitions. We're also going to see strategic financial mergers that will allow smaller companies that already have the assets to be able to develop the assets. Now, the longer we go on with this subdued price, the more we're going to see the M&A market intensify. Those companies that can't make it are going to be bankrupt, but those that have assets that are worth saving are going to be the ones that will be the attractive targets, and they'll be acquired before the bankruptcy takes place. So yeah, we're going to see it's creative destruction. We see this all the time when a market constricts this way, and we're going to see that take place as well in the U.S.
Yeah, I mean, low prices are the cure for low prices, and demand is going to the lower the oil prices stay, especially with summer driving season not that far away. The demand is going to start coming back if oil prices stay this cheap.
Oh, yeah.
The demand's not going to be tapering off. So I would be very surprised, Dr. Moores, if we see the oil prices stay this low for another 12 months or 18 months. I think
it's not going to happen. It absolutely will not happen. There isn't anyone I know who is of the opinion that the price won't be back to someplace between 75 and 82 within a year.
I think there's one Citibank analyst for oil saying oil is going to go to 30 or something. It's going to be a W-shaped recovery. It may go up for temporarily and then crash again. But I disagree with his analysis, and I agree with yours.
Yeah, I dealt with that. I dealt with that nice fellow, I think, in one of my analysis last week. So.
Yeah, I think we have to have prices between $65 to $90 a barrel, somewhere in that range, or the market's not sustainable for the producers. There's just going to be countries with civil unrest, either Venezuela or stuff, where a lot of production can come offline, and there could be bankruptcies for a lot of these shale oil producers once those hedge books expire, because they've used a lot of debt financing, which in the oil industry you're not really supposed to do, but they've done it anyway to drill.
Yeah. Oh, keep in mind one other connection here that is of interest if domestic prices remain subdued. We're going to see an expansion of the pain. A lot of these oil companies that are heavily indebted, especially the smaller oil companies in the United States, are translated heavily into investments into ETFs. So we're seeing exchange traded funds that are now becoming vulnerable because of the heavy debt encumbrance of smaller oil companies. Remember, over 80% of what it is you need to run an oil field, you have to invest before anything comes out of the ground. So this is front-loaded investment, and for that, many companies need expanded debt. So we're going to see some bond difficulties moving forward, especially in high-risk bonds, if these prices remain subdued.
Yeah, one shale company's already gone bankrupt, so I don't see how much it can be persisted, especially with a lot of high cost and debt. But my last question is in terms of investing in the oil patch right now, or the oil industry, what sectors do you favor the most, whether it's drilling, deep water producers, midstream, downstream? What do you like the most?
Well, you have to be very selective. I still have a list of companies that are on the small end. I mean, some of these are small caps, some of these are micro caps, but they own incredibly attractive assets. They tend to be magnets for money from other locations. And those companies I move in and out of our portfolios, the investment portfolios I advise as the situation warrants. There's still very good opportunity there. You have to start now comparing the relative costs of bringing production in across basins. Permian Basin is still tremendously attractive from the oil standpoint. The Eagle Ford is attractive, although it's deep, and so it's more expensive to drill, and you need horizontal fracking to do it. The Buddha and the Austin Chalk, Austin above, Buddha essentially below the Eagle Ford, may be more attractive. And so the companies that actually can parlay drilling into all three of those areas may be more competitive. On the gas side, the Marcellus continues to be the cheapest basin in the United States to bring in a profitable well. Now we're getting close. The average Marcellus well will come in profitably at a NYMEX price of $2.52 per 1,000 cubic feet. We're down to about, $2.80, $2.75 now. So we're pushing that, but we're already below the profitability of second-tier Barnett. And we're seeing companies not exercising leases in the Barnett and taking up leases in the Marcellus. So one of the things investors have to look for is not simply the bottom line and the profitability of the company itself, but where the company's drilling. Because the net differences in terms of cost outlays are going to become more apparent as we move forward. We've already mentioned MLPs that are strategic with their asset acquisitions. They are still a fine class, especially with the fact that some of these MLPs still are carrying very nice dividends. So it's both value and income. I've identified some tanker companies. We move in and out of these because this market doesn't remain stable for long. But I moved my people in and out, for example, of Frontline. Now, Frontline had been a disaster. I mean, its stock had probably collapsed 80% in a year and a half. But darn if you didn't need those tankers for storage. And rather than cut production, companies were prepared to lease out tankers to serve as storage areas for their crude oil. And Frontline went through the roof. I mean, it went up 180%, I think, in a matter of 3 weeks. Now, you got to be careful with these. You got to go in and out. These are not investments you make and then expect the returns to pay for your grandson's college education. I mean, you got to get in and out of these. We have some technology that is emerging that I think is truly going to be groundbreaking. The problem there, of course, is always that, because, see, one of the things that's occurring here is that as the price is going down, it's still getting cheaper to drill. And it's getting cheaper to drill because there have been technological developments that have allowed us to cut costs, especially in fracking, especially in the ability not to have to put downhole known carcinogens, experimenting with other forms than simply water fracking. There are new, less expensive ways of blowing replacement pipe into existing pipe, which is cutting the costs of having to renovate what is now an aging pipeline network. So there's a number of areas there. You have to be careful because a number of these companies are rather small companies. So if they don't get contracts right away, they tend to go belly up. But they will also become acquisition targets for some of the bigger boys. And so there's a lot of interesting things that are taking place here now. One has to be very careful with not overextending. And there are certain areas. Propane is going to become another major area for investment because the propane supply is once again a problem, especially in New England. And there are only a certain number of companies that can fill that. We're going to see a rise in the export of American crude. Congress will start loosening up those strictures. We're seeing condensate out of the United States already, but we're going to see other grades of crude moving. That's going to put a premium on certain companies, and we're already the number one world provider with oil product exports. And that tends to benefit some refineries better than others, those refineries that can hedge the American domestic market against markets elsewhere in the world that command higher prices. So there are a number of range of options here, but this is a very volatile period, which means that anyone's investment portfolio has to be reevaluated and reevaluated carefully. What I do with my people all the time, and it's what investors ought to do regardless of what they're in. I require that all my investors have a series of trailing stops. And the trailing stops simply indicate that to 20 or 25 or 30%, you automatically sell if that stock declines, say, 30% from the highest level since you've held it. And if a stock spikes right away, such as these three small ones we went in and out of this week, they go up 50, 70, 80%. If they go down 30%, you still pull out with a 40 or 50% profit. That's probably the least dangerous thing to do in such a volatile energy market. And, of course, if it goes up triple digits, you simply sell half of it, and it means that the rest of what you're floating, you're actually playing with somebody else's money. But you got to take these sorts of narrow views in this environment. This is hardly going to be a rising tide raises all boats.
Yeah, there's been enormous volatility since June, but as we put in the bottom here in oil, and I think if the oil market hasn't already bottomed, it's very close, but there's still going to be a lot of volatility in the oil price as we put in a bottom here. But like we discussed earlier, I think ultimately next 6 months or 12 months, I think the price is going to be quite a bit higher, and then maybe it'll stay in a much higher trading range going forward. But I think there's a lot of good investing opportunities in the oil market. I think people have to do their homework, though. They have to look for debt on the balance sheet. I think that's an important thing in this environment is how much cash can the company, if it's a producer or an oil service company, how much cash can the company generate, and when is their debt due? Can they afford the debt payments, or are they risking bankruptcy? I think that's one of the most important things for investors to do research on in this market.
No, I agree.
Well, I just want to thank you very much for your time. We've had a great hour-long discussion on the oil market. John and I have enjoyed it immensely. The oil market's just so amazing. I think it's the largest market with trillions of dollars in it, enormous amounts of CapEx. Most people don't realize how much technology is actually put into the oil market. Think, it's a dumb commodity market. I know a lot of value investors think that, right? But there's enormous amounts of technology applied to it to find new oil and reduce costs and come up with new drilling techniques, et cetera. And then there's just, like I said, so much money involved in this market and crazy geopolitical stuff, too, whether it's, OPEC squabbling or an economic warfare with Russia or, crazy stuff out of Venezuela. I think it's a very intriguing market for all of these reasons.
All right, and I agree, which is why, I've been arguing for years now that we're going to have an emerging new energy balance with more sources than we've ever had. But if people are looking for a silver bullet to wean us from oil, they're going in the wrong direction. Oil will remain for generations a component of this widening energy market, and you can make some really great returns by investing wisely in it.
Yeah, I completely agree. I think everyone should have exposure to oil and energy in their portfolio. I think it should be a permanent part of everyone's portfolio because, other than food, people use energy pretty much more than anything else. In order to run this complex modern economy we have for people who have smartphones and stuff, they have to have electricity and energy to power their cars and electricity for smartphones and things like this.
Absolutely.
Well, please tell listeners where they can find your work, where they can read it, your articles and your newsletters.
Well, the easiest place is to go into my free service, which you can acquire at www.oilandenergyinvestor, all one word, oilandenergyinvestor.com.
Great. Well, thanks again for your time, and hopefully we can have you back on again soon to talk about the oil market. John and I really enjoyed this discussion.
Great. Yeah, I'd love to do it.